All right, we are going to go through maximizing cash value, but really the topic of company selection. How do I make sure I select the proper company at the end of the day? Because when I am looking for a life insurance policy, whether it's a high cash value life insurance policy, term life insurance, universal life, whatever it might be, how many life insurance companies exist in the United States? More than you and I can count. It's endless sometimes. And you can turn the TV on and in about 15 minutes, you'll see an ad pop up, or you'll see it pop up on YouTube. You may have seen it pop up when you were watching this video about ladder life insurance or something like that. I see that all the time. So when it comes to, again, maximizing the cash value on a life insurance policy, what company do I choose? Because again, there's a lot of companies out there. Here's the thing. We want to avoid buyer's remorse in all situations. And what happens so much in the industry is often I'm shown a life insurance illustration that projects these great numbers where I look at it and say, wow, how come nobody ever showed me this before? I can pay my money into a life insurance policy and going back to the core benefits, safe, liquid, tax-free, I can borrow from it, all that great stuff. Like why has no one ever showed me this? And then I get into the policy and it just under-delivers. I saw these numbers and each year it performs less and less and less. And I think, okay, what's going on? My agent tells me something like, hey, the dividend rate has come down. That's why. But I look at the numbers, they don't make sense. A lot of people feel like that. I used to feel like that a lot when I would crunch things and try to figure it out. So this happens so much in the industry. And what we touched on in the prior video or past several videos, policy design plays a big role in this, but company selection does too. We do not want a policy that overpromises strong cash values and then underdelivers. What's important to look at here is illustrations versus actual performance. Actual performance is difficult to obtain. And I want to be very, very clear here. When I say actual performance, I do not mean a company's dividend history. We see this all the time. Oh, look at our dividend history. It's phenomenal. No. I want to see real whole life policies that have lived the test of time and what is the net internal rate of return. And obtaining these from companies can be difficult, but what we have found for companies have provided proof of performance. We see it consistently provided. As we've been in business for some time now, we have these policies. We've been able to measure the actual performance over time. And a lot of people we work with have been very, very kind to share policies that they owned that have been 20, 30, some even close to 40 years old, where we were able to track the actual payments made and then what the cash value actually grew to. Sometimes we were provided the original illustration. That was a lot of fun to see what actually happened, but we've got other videos on that. Here's what I want to touch on here. So 4 major mutual companies, the big 4, I love that word. Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Cream of the crop in terms of insurance companies, in terms of their financial ratings. All stellar. If I look at the Comdex score or scale, you'll see those 4 companies range between a 98 and 100. AAA rated, top tier, as good as it gets. From a financial size standpoint, they are all massive insurance companies. If you look at banks, corporations, going back to banks, BOLI, bank-owned life insurance, when we've put policies in force, guess what companies we use? 4 major mutuals, all except Northwestern, and I just want to be very transparent here. We don't use Northwestern because they only work with their career agents, meaning we're an independent brokerage firm, we're 100% independent, and because of that, we cannot offer Northwestern Mutual. I was with them for a short period of time many years ago, stellar company, and why they're on this list, even though we make 0 profit from them because we can't, is because we've seen them actually deliver. So we always want to be transparent when providing information. So again, 4 major mutual companies, present dividend rates ranging from 5 to 6%. Some information I want to add here is if you're looking to purchase a policy, to open a policy for maximum cash value, we touched on policy design. Design's critical. You can design policies with minimum premiums, maximum PUAs, with each of these 4 companies and many other companies out there as well. If a policy is designed properly, let's say it's designed identical with a minimum premium, maximum PUA allocation, which with each of these 4 companies, you can close your eyes, pick one of them out of a hat, and you can't go wrong. Based off the present dividend rates, some companies will illustrate better than other carriers. However, we have found in terms of real, actual data, historical performance, they all go back and forth with each other. They all say, hey, we're the best, and we've got a million ways to prove it based off of our comparisons compared to others. But when we look at actual independent policies, it's like, all right, they go back and forth. If one was clearly better, we'd be saying go with this one, but we haven't seen that. So again, 4 major mutual companies, historical, real, actual performance. That is the nail in the coffin for me that says, hey, they've actually done it. It's not just a projection and I'm hoping it comes true. Even though I've never seen it before, I want the real stuff. Now, still 4 companies. What will help me refine my decision-making process when looking at different life insurance companies? So if I were to focus on these 4, they all have different flexibility provisions in terms of their PUA rider. I'll let you know that we primarily use Mass Mutual and Guardian. The main reason why has to do with their PUA flexibility. I'll give you a quick example. If I look at Mass Mutual, if I set up a policy properly, utilizing their LISR and AILR rider, particularly their LISR rider, as a consumer, as a policyholder, I can adjust payments 1 time per year, every year, without any underwriting. And that's the key here. A lot of times you'll see insurance companies come back and say, hey, if you want PUA flexibility, let's say you have a good year and you want to throw $50,000 into a PUA rider to hyper grow the cash value. Some companies and their PUA provisions will allow you to do that. Other companies won't. When I add money into PUAs, what happens? It grows my cash value, but the term PUA stands for what? Paid up additions. Meaning when I add $50,000 or any dollar amount into the policy, it will buy me paid up additional life insurance. If I throw in 50 grand, it might buy me another 150K in death benefit. So what's important to be aware of here from an insurance company's perspective is if I want to throw money into the policy, what happens is they say, okay, hold up. We want to check your health to make sure that you're not just throwing money in because you found out you have cancer or you're going to die tomorrow and trying to cash in for your beneficiaries. We want to check your health first. A lot of companies do that. Now, if the policy is designed properly, we can bypass that because what happens with most people is we've got a lump sum of money, we want to add it into a policy, and the last thing I want to do is have to jump through a bunch of loopholes to say, okay, I've got to go through underwriting first before I can get the money in. It takes several weeks. It's a pain. Like, no thanks. So if a Mass Mutual policy is constructed properly, I can make payment adjustments 1 time per year on my policy anniversary date without any medical underwriting. That's the key there. Now, if I were to look at Guardian, how their PUA flexibility works is I can commit to the base plus term rider only, specifically their OYT, their 1-year term rider, and then 100% at discretion, I can add PUAs to the policy on an unscheduled basis. I can log on through my mobile app, through my online portal on my computer, whatever it might be, and just dump money into cash value over the course of the year. Very, very flexible in that respect, if the policy is constructed properly. If it's not constructed properly, I won't be able to do that, or I can, but there's more restrictions. I would encourage you to check out our All About Mass Mutual or All About Guardian video if you'd like more details. We do have information on the other carriers as well. We can use New York Life We don't use them a whole lot just because of their flexibility provisions, but they can work as well. So if you're in a position where you'd like to look at a variety of companies, we can certainly do so. Again, we can look at all of them except for Northwestern. If you really want to see Northwestern, we do have a contact we reach out to that can help provide any illustrations, and they're aligned with us as well. They actually work with Scott Witt, the actuary we consult with and work with at times, and the individual at Northwestern is aligned with him as well, with a goal of maximizing cash value for the consumer in any and all cases. But again, cream of the crop companies in terms of actual data, real performance. Don't have to worry about them playing a bunch of games or anything like that. But this is always an interesting topic, right? What company do I select for maximum cash value? Because I want to know. I don't want buyer's remorse or to find out a company underdelivers. You know, there was a time or a couple cases I can think of. Remember at one point when I was relatively early in my career, was meeting with a physician, and he had policies through a smaller company. He was told that he was earning a high rate of return. The agent had let him know he was earning the dividend rate, or at least this is what he thought. A lot of times we're told, hey, the agent told me this. Maybe it was just communicated poorly. But the consumer thought he was earning the dividend rate. Hey, I'm earning 5.5% on this policy. We crunched the internal rate of return. What actually happened, it came out between 2.5%, 3%. This was with a small company. He just looked at it and said, that's pathetic. Like, that's not what I was told. He was upset, looking at different companies, purchased policies with larger companies, very satisfied with them. More recently, was speaking with an individual who does very well for himself, and he was pitched on a smaller company by another group, and he said to them, there is no possible way I am floating this kind of money through a small company. I want one of the top companies. No, I want the best, one of the best mutual companies out there for my whole life insurance policy. And he's looking at one of the top major mutual companies. So a lot of info here. If you have questions, feel free to reach out anytime. I do hope this helped provide some insight as far as what company to select, a couple of bullet points there and flexibility. If you have any questions, reach out anytime. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.